Hi everybody, and welcome back to our last video in Chapter 10. Here we're going to be looking at the Appendix 10 Alpha, and it deals with environmental, social, and governance, an expanded set of responsibilities. Let's take a look. Here, we need to understand the meaning of environmental, social, and governance responsibilities and their effects on reporting practices. A company's stakeholders require that it delivers strong financial results, but also conscientiously attending to its environmental, social, and governance responsibilities. So let's take a look first at environmental performance. And that refers to how an organization processes, policies, products, and packaging aimed at improving environmental sustainability. It focuses on reducing a wide range of environmental factors. Social performance focuses on how organizations improve the health, well-being, and rights of all stakeholders, including employees, suppliers, customers, and local community members. And finally, our governance refers to the policies and practices used to direct and control an organization. All right, so most companies realize overlooking their ESG responsibilities creates risks, and some of them large financial risks that can damage their reputations. If a company hopes to fulfill its ESG responsibilities, it must have a performance measurement system in place that informs and properly motivates employees throughout the organization. A framework for organizing a company's ESG performance measures is the balanced scorecard. We talked a little bit about the balanced scorecard in the previous videos in this chapter. Here is some of the examples of ESG measures for balanced scorecard. So environmental and social and governance. Here we have learning and growth, a number of LEED certified facilities, the number of product engineers trained in eco-conscious product design. And then for social, we have a number of occupational injuries and accidents. This tends to be a very expensive proposition not done properly in a company. The average compensation for female employees divided by the average compensation for male employees, the percent of job applications that are underrepresented groups that are hired, and finally the average community service hours per employee. When we get to governance, we're going to take a look at how many female directors versus the number of male directors that we have, the number of board members receiving ESG training, and the percent of employees that strongly agree with the statement, my company has supportive and inclusive corporate culture. So if we look at internal business processes for environmental, we have average water consumed per unit produced. We have the percent of raw materials input that had been recycled. We have the number of pounds of waste produced and the average carbon emissions per unit produced. Carbon emissions beginning to have a very wide acceptance as to how we can control that better. The number of product under social, we have the number of product warranty claims divided by the sales revenue, and the total cost of quality divided by sales. And lastly, under governance, we have the number of certified diverse suppliers, and then the number of suppliers having third-party verification of child labor law compliance. Now, if we ease into the customer side of things, environmental, we have percent of customers that strongly agree with your statement, your company is committed to environmental stewardship, and then the percent of customers buying eco-conscious products. Under social, the percent of customers that strongly agree with your statement, your company cares about the communities where it operates. And number 2 here, percent of customers that strongly agree with the statement, your company has a superior commitment to product safety. And under governance, the percent of customers that strongly agree with the statement, your company provides me with the information I need to assess its environmental and social performance. And then number 2, the percent of customers that strongly agree with the statement, your company conducts itself in an ethical manner. So in our last category, financial, under environmental, we have the percent of revenue from eco-conscious products. Number 2, the average fuel cost per sales dollar. And then 3, the capital expenditures on green products and processes. Under social, we have our total workers' comp costs. This is a large amount of money potentially that can be avoided if we're careful with the way we address our safety. Number 2, the dollars invested in data security divided by the cost of data breaches. Of course, data security is more and more sophisticated, contending with more and more sophisticated data potential breaches. And lastly, under governance, the total tax saved via environmental tax incentives. Number 2, the CEO compensation for average employee compensation. And then the percent of investors that strongly agree with the statement, this company provides timely and transparent financial disclosures. Okay, for external reporting, most of the world's largest companies prepare ESG performance report for their external stakeholders. There is not yet consensus, however, regarding the standards for these reports. As ESG reporting evolves, assigning monetary values to various social and environmental performance metrics will better enable stakeholders to assess a company's sustainability practices. For example, the California State Teachers Retirement System is a massive investor with billions of dollars of assets that they're investing. And they have quite the ESG profile for those investments. So it's not just something that is going to be here today and gone tomorrow. These are very important metrics that will become more and more important as time goes on. So our standards and sustainability development goals, the SDGs, various organizations have created their own ESG data collection and reporting standards. And here we look at Global Reporting Initiative. Number 2, Sustainability Accounting Standards Board. Number 3, the United Nations Principles for Responsible Investment. And number 4, the World Economic Forum and International Business Council's Collaborative Stakeholder Capitalism Metrics Initiative. The SEC has now proposed new disclosure rules requiring companies to report their own emissions as well as those of their supply chains and other indirect sources. And so that ends our video on Appendix Alpha. And when we continue, we will begin our videos on Chapter 11. Until that time, bye for now.